Hey guys, Freaky Finance here. As you can see behind me, we're getting ready for Halloween, so the video release was a little bit delayed for this weekend, but we've been pretty busy decorating. Halloween is fast approaching. Anyway, today we're gonna go back to Canada on the utility side. There's just so much cheap things happening in Canada right now, especially for higher quality companies. Like, we're seeing a lot of sell-offs. Some are approaching COVID panic lows, some are already past that, and they're decent businesses in the long run. So we're trying to pick them up as the multiples come in on the higher rates. I think I did an AQN video before, and I might do an AQN video again now it's getting cheaper as well. I've already been adding to that one quite a bit, and I'm going to start adding to AQN as well, I think, especially if it keeps going down 3% every day. So Algonquin, I think I talked about this before, with Fortis and Emera. Basically, it's a bulk up strategy, and most utilities do this. They try to bulk up as big as they can to get the biggest growth they can. There's a couple of reasons why they do this, but really, it comes down to a cost of capital game. The bigger you are, the more diversified you are across different regulated geographies, with different regulators, so different regulatory risk, the lower your cost of capital should be over time. At the same time, the faster you grow, the better PE multiple you'll probably have. For example, say if Fortis has like a 19 PE multiple versus like an ACO, which now it's under 10. AQN's probably getting close to under 10. So what I'm trying to say there is that these higher PE multiples enable them issue equity at a lower cost of capital as well. So what this means is that really utilities nowadays, modern days, are really momentum utility plays where they grow on themselves really quick, and the quicker they grow, the better their cost of capital, the quicker they can keep growing, and it's less dilutive to current shareholders the higher their share price is. So what happens when that reverses is that it becomes quite painful because your growth rate slows down while your R is going up, both at the equity side and also on the debt side. So we're seeing that with AQN, and it's exaggerated a bit with AQN, both probably from an emotional response because it hasn't happened to these guys yet, as well as from a fundamental response because they had higher exposure to floating rates going into this upcycle relative to other utilities. And they did a number of other things that didn't necessarily help them, but they've taken quite a bit of actions that I would say are beneficial to the long-term regulated business. AQN does have a large renewable business, which we'll get into, which is more volatile and goes up and down based on wind, really. And we'll jump into that as well. So let's get into it. AQN kind of just briefly said the regulated side, which is your more what you're thinking about it as a utility. Then your renewable generation side, which is more of wind generation for these guys. They do have solar and thermal, but the large part of it is wind. You can see the bulk up strategy tends to work over time. It's up to the right in terms of assets, up to the right in terms of EBITDA, right up until it doesn't work. And how it does that is through debt. And this isn't unique to AQN. We've seen this with Fortis and Emera. And that strategy was working. They were outperforming. Now I'm going to borrow from Starwood's presentation that just came out for October. I think it's very good. So I'm going to transfer between the 10Ks and this presentation because I think it visualizes things really well, the storyboard behind it. What else is happening? So part of the utilities always need investment grade. Well, they don't always need, but they should strive for investment grade because that's the way, again, it links to the cost of capital part that I just talked about. It's critical for utilities to have the lowest cost of capital they can have, and one of the ways you can do that is by ensuring you're always investment grade. Like I kind of said, when your stock's going up, about half your financing is issued through equity and the other half through debt. And the equity part can be divided into your DRIP versus actual equity issuance, but basically it's just a bulk up game. And the better your share price is doing, the less shares you have to issue. And technically it also means the lower your cost of capital on the equity equation side. What happens though is when all of a sudden your equity gets cheaper, all of a sudden your cost of capital on the equity side gets out of whack, and at the same time you're getting hit because the cost of capital on the debt side, your interest rate, is getting higher. So you're getting hit on both sides of the financing equation here at AQN. And this is negative momentum. It pulls from CapEx, so they're basically going to grow less, which also lowers the PE multiple, which further lowers the ability for them to issue shares to keep growing, increase their cost of capital on the equity side. The slower you grow, the higher that will be. Anyway, prior to the current year, you can see the strategy is actually working okay in terms of EBITDA, in terms of revenue, but not in terms of EPS. So one of the things that was starting to happen during last year, interest rates started going up. So one of the things with EBITDA is you add back the interest rate expense. So we actually saw a divergence there where EBITDA was still going up, but interest was eating into the EPS growth for the year and actually posted a negative growth rate. That was one of the things that happened. They also decided they were going to buy Kansas City Power, I think it was, and that was also going to increase their floating rate exposure and their debt level. They recently backed off that, but at that time, that was another reason why the share price tanked around winter of last year. It rallied after the fact because eventually the transaction decided to fall apart. It was no longer in the best interest of AQN, which made sense given the share price reaction at the time. So that transaction actually not happening is actually a good thing in the long run for this company and the health of this company. Anyway, when I talked about this enough, while I own it on the Canadian side, it's actually very much an American play. And we've seen American utilities also get crushed in the last 3 months. And AQN is going down with them as well. And aside from their internal issues. You can see, well, they do have some Canada on the regulated side. I mean, it's 3% of the business. It's less than Chile's exposure. So it's very much a US and Bermuda play. 93% of the regulatory utility business. The renewable side is interesting. This is what they're currently planning to sell off. One, it's more volatile. And two, it will help lower their interest expense and their debt profile to basically secure the utility side, which is still growing as we speak. And we'll go into the quarterly numbers lately. You can see the difference between the two performances and how one's way more volatile than the other. In terms of where they are in the US, it's very much, I'd say, Missouri, New Hampshire, California, New York. You can see here they break it out 86% of their regulated business. The remainder is just 14% of the other ones. So very much just think these 4 states. That's how I view it. And that's the key regulatory risk as well. So they have key regulatory risk in Missouri, New Hampshire, California, New York. Here's just a way to show that, like, the actual operating names, if you were to go into it to see who they are in each of the places. You can see in California they operate under Calpeco, Granite State in New Hampshire, Mid-States Gas in Missouri. And in New York, they have quite a bit of water exposure through New York Water. That's actually one of the unique things about this utility is the amount of water on this regulated side. And that's really the gist of it. We'll go into the wind, but I view it a little bit differently. But you can see it's very much Virginia, Delaware, Illinois, Minnesota, Manitoba. Very much New Hampshire, New York, Missouri, and Cali. Just how I view it. Again, this presentation from Starwood's very good and very timely for this purposes of this video. And you can see again, electricity is a huge part of the regulatory side, 58%, so almost 60%. It does have 20% water, and on the renewable generation side, it's very much a wind play. So people will lump in renewables, but for our purposes, it's 81% wind. So that's going to drive it. Whether wind blows or not is going to influence this this renewable energy results in any quarter. Here you can see on the renewable side, one of the cool things with AQN is that it does have 20% water, which is what other ones don't have. So if you're looking for diversified inside utilities for a water utility, this one actually has some, whereas well, you can see in the peer group average, basically no one has any, which is interesting and kind of unique. In terms of assets on the regulatory side, again, it's driven by electricity, so it's really electricity regulatory play. Again, this is about 60% of the assets, 4.7 into 8.5. So it ties into what that other presentation was saying here. One of the cool things AQN reports is kind of like what we did last year on the renewable side, renewable generation, and kind of the drivers. And you can see last year that actually picked up because of better generation year over year. Now this recently reversed, and that's one of the reasons why I think there's even more pressure now, is because the last results for Q3 were very bad for wind generation, whereas the utility side actually did okay. And so what I'm thinking is once the renewable business is sold off, the balance sheet gets better. This will eventually re-rate more like a regulated utility, which it currently trades about 70% cheaper than the other ones. That's what I'm thinking. That's why I'm in it, and that's really the catalyst in the long run. And eventually, it's also, if you're buying a utility now, you're also making a call on interest rates over time. You think eventually they're going to start going lower again, which AQN would be a beneficiary of, and so would all the other bond proxy plays. So that's also why I'm looking at utilities now, because I do think, especially in Canada, I'm just seeing slowdowns across the board, right? Unemployment keeps going up, more and more layoff announcements, and mortgage rates keep resetting every single month, every single week at a rate that's 4% higher than what they were paying before. And it's just every month we're seeing it. GDP is already slowing in Canada quite a bit. It's not an American economy. It's very much getting hit right now with higher rates, and I think it's already been showing up, but people are slow to realize it. This was the year over year for wind generation, just to show, well, for the whole renewable group, but I'm focusing on wind because it's 81% of the business. But you can see part of the reason for they did well year over year is because they actually had more assets online in Canada. The wind generation in the States wasn't even that good last year relative to prior year and relative to their long-term average power generation that they should have had. So they've been underperforming in my mind on the renewable side, but that's just my opinion. What else? So this is basically they're making a value call that basically they're 7x discount multiple difference to their average, and that does check out. It does screen very cheap relative to other peers in the industry, especially if you're just looking this at as a as a utility company, and you take out the renewable part. It trades very cheap relative to peers. It does pay a very high dividend. They already cut it once because the performance has been lackluster and they were seeing interest rate pressure. And we'll go into what that means in a second, the last quarterly call. One of the things is that the unregulated renewables has been growing as a percent of the business, so it does set them up for more volatile earnings. So when you're generating more, so if the wind's blowing more, they're going to put up better results, and if it's blowing less, you're going to put up less results, and that leads to more volatility. And for people who might want just a stable, boring utility play, that would mean that this would be more convoluted as an investment and more riskier. And we've seen companies like NE just crash in the last 3 months, right? And that's, again, part of that's renewables in the States. And it could also be trying to be some type of political proxy if some of the recent renewable push mean reverts, right? The current multiples already imply that's going to happen. Anyway, you're down from, so this is fun. After the announcement when they were going to acquire Kentucky Power, the thing shot down 19% that day. Basically, the market was saying, yeah, no, you're not going to acquire that company. Your debt's already too high and you already have too much floating rate exposure. And so this is them having a hissy fit, the market. And then actually, after this period, it actually went back up. And a part of that was the market front running that the actual deal wasn't going to happen. So it's going to reverse that. And then after that, the deal actually didn't happen, which is good. But the share price still went down as rates kept going up. And part of that is also the renewable issue that I talked about. Like I mentioned, they already cut the dividend. Doesn't mean they can't do it again. Currently, if they sell, there's an if here, they need to sell the renewable business, and that would give me more confidence in the current dividend yield. It is higher. It's one of the reasons why I've been holding off, especially when I have something as cheap as ATCO in the competitive set, which I'm hoping will get even cheaper after they report the next Q3, which should be the worst PBR reset for ATCO, but that's a different utility. But anyway, here, they did cut it once already, and again, that does help. That's what you're supposed to do to ensure that you keep investment grade rating, especially as interest rates chip into the earnings per share of the company. Unfortunately, this does hurt the cost of capital equation on the equity side as the share price reacts negatively to dividend cuts. Here's the actual financials in the latest quarter. I would say you can see regulated electricity actually doing good, which again is 60%, 58% of the regulatory business. Natural gas looks down in revenue, but again, part of that is just pushing through the costs. So you can see COGS is down 15 million. And natural gas revenue is down 12, so really it's a flow-through equation. These utilities are what you'd consider more stable, and they do slowly appreciate over time as the rate bases push up and more rate payers come in, just general population growth in the geography that they operate in. And they are cost of service, so if their costs go up, they're able to push it through as long as they're reasonable. We haven't seen too much pushback on regulators for AQN, aside from the Kansas City thing, which was a thing they no longer have to deal with. There is a negative here, is that they keep seeing more and more admin expenses. They did pick up a new CEO. We'll see if that also adds to the year-over-year increases. But here you can see operating income decrease. This is largely from the renewable generation business, from especially wind in the States, whereas the utility side of the business continues to slowly grind up over time, which is what you'd expect. But here you can see interest expense just shoot up, and basically, usually there's a gap here, right? Your operating income less interest, it's usually what you're going to be taking home as a common shareholder, and you can see that just got destroyed, that gap. And that's been the trend even on 6 months. Amplified here because the wind generation was down for the latest quarter, which I think the share price is still reacting to. It's just extrapolating very bad news into the future, which it could happen, to be fair, right? And we don't know. The biggest risk in my eyes is we don't know when the renewable sale business goes through and at what price. So I think it will be sooner rather than later. But I don't know what price they're going to get for the renewable business. Now, I think it's going to be higher than what the company's currently trading. So it will be a net benefit, especially because they're saying they're going to reduce their debt and also buy back shares at this very low share price, right? It's instead of like other companies, the utilities that are maybe down 30 or 40, this company's already down 60, going to 70. So it's a very good time to buy back some shares, especially if you're just going to be regulated utility business after, with your multiples so much cheaper than your peer group, as your balance sheet gets better because you're selling off the renewable business. Anyway, that's what I'm thinking, and that's why I'm in it. In terms of the cash flow, which is more important, you can see relatively stable in terms of CFO in the 6 months year to date. Part of that is working capital adjustments, but they have been consistently writing down their fair value investments. That's another noisy thing here, but really you have your net income and you add back your depreciation, and that's kind of your benchmark, what you're looking for cash flow from after noise. And that's kind of just how if I was just looking at this really quick, which I am, Usually what I do is I like to write this out myself, and I'll do my little Excel spreadsheet and share it with you guys, but I couldn't do that today because of the decorum behind me. It's been busy. Anyway, we have seen the dividend get cut. You can see that here in different dividends on common shares going down 60 million. So they can still cover the current dividend with the CFO, but it is tighter. And they've also cut back CapEx. So you can see that here as well. So they are responding to the weakness in the share price. You can see here, this is how, if like they do a good job on their quarterly, it's on page 17. And you can see that the regulated business is up year over year, and it's up on 6 months as well. So you can see still grind up in EBITDA for the regulatory side, which is what you want, especially if we're going to be holding, if they ever sell the renewable business, that means we're just going to be holding the slow grower over time while they're deleveraging the balance sheet and buying back shares at a low price with the proceeds. And this is the one that's volatile. You can see that very clearly here, just dropping so much year over year, and that had enough of an effect to reduce the EBITDA, so you're no longer a slow growing utility play. And that's before the higher interest expenses, the EBITDA line. Anyway, very bad on the last quarter is what I'm trying to say, but really it's a tale of two cities. You have very good, I'd say, standard utility growth, and then you have the renewable business generation doing very bad. Now, this is another thing they break out on the months for the quarterly. And you can see really what's driving the year-over-year growth on the regulatory side is electricity rate reviews. So basically you're able to push your costs over time, the utility, and that's what this is. And it was largely driven by the electricity side, but on the opposite side you had declines across the board in wind generation specifically. Another way to look at that, they actually show this, which is very nice, and you can see just how bad the US was for wind generation last quarter, pretty much across every site they operate. And that's a material move, right? Going from 1.4 to 1.1. You can see that here for total renewable energy performance getting clocked year over year. So that was the largest reason for the decline in EPS year over year, which was amplified also by the higher interest rates eating into interest expense for the bottom line. So getting hit across the board on all fronts currently. And that's why I think the share price is as cheap as it is. On the longer term perspective, you can see the slow growth of a bulking utility over time does pay off. You can see it going from 24 cents to 33 cents, 37 cents to $1 and $1.30. And then you get the reverse side of when the R's go up and you can no longer issue shares to keep growing. Your multiple contracts, your EPS gets spanked. And to add to the noise, you have more and more of a renewable business, which is more volatile depending on which way the wind blows. You can see that all of a sudden you're swinging crazy and the share price is reacting to that volatility. I think that's the main gist of what I want to talk about. It is screening cheaper relative to peers, and will likely do so until I think they actually sell the regulatory business. Sorry, not the regulatory business, the renewable business at hopefully a good price. And now this share price is even cheaper than when this thing was. I think this thing, AQN, I think just went down another 10% this week. So I'm trying to time the video. That's why I want to get it out before before this weekend's over. Anyway, it does trade at a discount. Trades at a discount on the utility side. It trades at a discount on the renewable side. It trades at a discount combined. So it does screen very cheap relative to other utilities. And part of that is for the reason of a higher debt load and a higher floating rate of interest expense. And their plan to get out of this makes sense to me. But again, your key risk here is getting a good valuation for the renewable business, because that will be driving the both the share price buybacks as well as the deleveraging on the balance sheet, and give them more cash to keep pushing into the regulatory side, the regulated side, which is the more stable, slow building one. I think the strategy makes sense, and we just don't know what price they'll be able to execute on it. Anyway, I'd like to know your thoughts on AQN. There's a lot of cheap things going on in Canada right now. But yeah. Anyway, have a great rest of your weekend.